What is going on, everyone? How are you guys doing today? Today's date is January 25th, 2021. My name is Ryan Williams, and we are back with another episode of Market Mondays. All right, guys, well, it feels good to be back. We actually missed last week's episode of Market Mondays. The market was closed last Monday, which made it impossible for us to buy stocks, so we just had to take a rain check into this week. Anyway, like I said, it feels good to be back. Today's episode is probably gonna be a relatively quick episode. We're only gonna be buying one stock. And if you guys saw my previous video where I gave you an inside look into both of my portfolios, I had some pretty big news in that video, so you actually might want to check that one out before watching this one. I will link that video right here. But anyway, if you saw that last video, you'll know that going into this week and into the future, my primary goal is gonna be to catch up on some of my lacking holdings, some of my lacking sectors. And right now in my portfolio, I need to catch up on financials, AKA bank stocks like Bank of America and JP Morgan. And I also need to catch up on some healthcare stocks like Johnson & Johnson or Pfizer. Those are the two healthcare holdings I have. So that was my plan, but guys, I'm actually gonna have to call an audible on that one for today. In today's episode, we are just gonna be buying one stock. We're gonna be buying Coca-Cola, and I will explain why as we get further into the video. So stay tuned. It's gonna be a good episode. It's gonna be a quick one. And before we get rocking and rolling in today's video, if you guys wouldn't mind doing me just a quick favor and give this video a big thumbs up, that would mean the world to me. And while you're at it, if you wouldn't mind hitting that subscribe button so you can stay up to date on all future videos, that would be amazing as well. All right, my friends, and now that that's taken care of, without further ado, let's get into it. All right, guys, so first things first, let's open up Robinhood and see how the portfolio is doing today. Okay, not too bad, down just a tiny bit. It is all good. And real quick, so I keep referencing this video, but if you guys saw my last video, man, I almost don't want to spoil anything if you haven't seen it. So, all right, I'm just gonna spoil it. In my last video, I essentially told you guys I'm gonna be combining my Robinhood portfolio and my Charles Schwab portfolio, and then I would be transferring everything we're seeing right here, this account, into my Charles Schwab. So based on my last video, you guys might be surprised to see me still on Robinhood. Obviously, I haven't made the switch yet. I'm thinking I will give it one more week on Robinhood, maybe do one more Market Mondays next week, and then after that, just transfer everything into Charles Schwab, which from what I've heard takes about a week or so to do. So anyway, next week will probably be our last Market Mondays looking at Robinhood. You know, it's a little bit sad, I love Robinhood, but it will be good to make the switch. So sorry if I spoiled that last video for you guys. If you still want to watch it, I have it linked. All right, guys, so as I mentioned in the intro, my plan kind of moving forward was to focus on building my financials positions and my healthcare positions, but like I said, I'm gonna be calling a little bit of an audible for today's video. Instead of buying anything in those sectors, I'm actually gonna buy just $100 worth of Coca-Cola. And there's a couple reasons for this. I mean, number one, I really love Coca-Cola. It's a great company, it's a stock. For some reason, I have a lot of fun buying it. More importantly, I am down quite a bit in Coca-Cola. So as you can see right here, total return, I am down almost 8% on Coca-Cola. Which means I have a pretty good opportunity to decrease the average cost of my shares. So if we're looking here, the average cost of my 10 shares of Coca-Cola is $52.89. However, if I'm able to pick up a couple shares today, we'll see that average cost go down just a little bit. And the lower that the average cost of your shares is, in the long run, it's actually gonna be more beneficial. It makes it easier for you to be net positive in your holdings, number one. But number two, having a lower average cost per share will also increase your yield on cost, which essentially measures your percentage of dividend yield divided by the average cost of your shares. So the lower the average cost of your shares, the higher your yield on cost is gonna be. Anyway, long story short, today makes for a good opportunity to pick up some Coca-Cola at a discount and decrease my average cost per share. So that's why I am gonna be buying this today. Now, I don't wanna make a habit of this. I really wanna stick to the plan. And actually, you guys hold me accountable, please, I need it. So just for today, we're gonna be buying some Coca-Cola. I'm already very heavily weighted in consumer staples, which is the sector that this will fall into. So like I said, I don't wanna make too much of a habit of straying from the plan, because really I need to balance out my portfolio the way that I have kind of outlined it. So I need to stick to that. but like I said, this is just too good of an opportunity to pass up. So anyway, let's go buy this stock today. We're gonna put all $100 into Coca-Cola right now. And to do this, we're just gonna hit trade, buy, $100. And real quick, before I go any further, I think this $100 is gonna get us just over 2 shares. I think the current price of Coca-Cola is like 48 something, so with $100, we'll be able to get maybe 2.2-ish shares, 2.1 shares, somewhere in there. So let's hit review. Okay, 2.05 shares, not bad. And let's swipe up. All right, great. So as you guys probably saw in real time, the average cost of these shares went from like 52.80 something down to 52.19. So just buying a couple shares today brought the average cost down about 70 something cents. And prior to this purchase, my total return on Coca-Cola was like negative 7.7. And after the purchase, after the transaction we just made, the new return is now just down minus 6.54%. So we were able to increase our total return by about 1.2% just by buying these shares at a discount today. So in the grand scheme of things, it might not make a huge deal, but I saw an opportunity today, so I wanted to take it. Anyway, super simple. I was probably rambling quite a bit through this, so I apologize. Now let's move on to the next step and input this trade into Track Your Dividends. All right, guys, so what we are looking at here is trackyourdividends.com. And in case you have never ever seen this platform before, it is a free online tool that you can use to essentially track your dividend portfolio performance, and it'll give you certain metrics like your portfolio's current dividend yield, your yield on cost, and last but not least, your annual dividend income. So very cool metrics to keep an eye out for. So I use this for the reasons I just described. I like to keep track of my dividend performance week over week over week, and every week it's pretty cool when we make these updates. We see this annual income go up, and sometimes if we're lucky we'll even see the dividend yield go up, but truth be told, I'm pretty happy where it's at. Anything 4% or above, it's pretty nice. So anyway, what we're looking at here, guys, this is a summary of both of my portfolios, my Robinhood and my Charles Schwab portfolio, which when combined has a total portfolio value of about $19,700. This number might not be quite accurate, but that's okay. Also, when combined, these portfolios have a 4.11% dividend yield and pay an annual dividend income of $812. And real quick, guys, I'm kind of estimating, I don't have any set numbers, but I think we'll see this dividend yield go down a little bit because I do believe Coca-Cola pays like a 3-point-something% dividend yield, which is fine. But obviously we'll see this annual dividend income go up. I'm thinking we'll see it go up from $812 to maybe about $816 or so, maybe $817 if we're lucky, but no more than like $5, $6. All right, so anyway, with that said, let's move on. Now we need to go update the Coca-Cola holding in the Robinhood account. And to do that, we're just gonna go over to portfolios here on the left, hit this little drop-down menu and click on Robinhood, and it'll take us and just show us our Robinhood account here. And now that we're in here, we can scroll down. Let's find Coca-Cola real quick. All right, right here. But let's hit edit. Okay, so like I said, we have 12.050015 shares at an average cost of $52.19. Sweet, so now we'll hit edit. Cool, so it went up a few dollars here in Robinhood. Now let's head back over to the summary page and see how this purchase updated the portfolios as a whole. Okay, so we were pretty much right on the money. It looks like the dividend yield went down about 0.01%, which is hardly any at all. And the annual income went up just as we predicted. It went up to $816, so no more than $5. Nothing crazy today. And real quick, while we're here, guys, let's take a look at some of these holdings here. So as you guys can see, Coca-Cola here is my least profitable holding. I'm down $47 in total on Coca-Cola, which across these portfolios, I don't know exactly what percent that is in total. But anyway, that's the biggest reason why I wanted to buy this company today versus sticking to my plan well, I originally was gonna buy JP Morgan, but I decided this would be a better trade today. So that's essentially why I wanted to do it, like I was saying, just because it's so down. It's a good buying opportunity to decrease the average cost of these shares and hopefully increase this yield on cost a little bit. So what happens, as you guys can see right here, when we are at a loss in these holdings, the yield on cost is less than the current dividend yield. And that's because the average cost of our shares is higher than the current price of the share. So whenever that happens, you'll see a yield on cost that's less than the current dividend yield of the companies that you own. Hopefully that makes sense. And you can see that holds true both with EPD and AT&T. Otherwise, the yield on cost is greater than the dividend yield of all of my other holdings. That's because I'm profitable on all the other ones. And also, kind of the last thing I want to touch on here, when you do have stocks that are in the red or not profitable, don't worry guys, especially if they're dividend paying stocks. The good thing about dividend paying stocks is you're not necessarily relying on the price of the shares to go up. When you're buying these companies, you're more so relying on that dividend income being paid out to you. So as long as that is still there and as long as the dividend is still growing year over year and still being paid out, that's really what you have to look for. Otherwise, when these stocks start to go down in price, well, that just presents a good buying opportunity. It means you're able to buy some good cash flow at a lesser price than maybe you normally would. So essentially, you are bargain shopping for those dividends, and that is always a good thing, as I'm sure you can imagine. All right, my friends, well, that pretty much wraps it up for today's episode of Market Mondays. As I mentioned, this one was gonna be a relatively quick episode. I think more than anything in this episode, I was just kind of rambling and ranting, but hopefully you got some value out of that. And with that said, thank you guys so much for sticking through to the end of this video. It means a lot that you take the time to watch these and give me that time out of your day. Now, before I sign off for today, I just wanna remind you guys, if you haven't done so already, please give this video a like, give it a big thumbs up, that would mean a lot. And while you're at it, hit that subscribe button so you can stay up to date on all future videos. All right, now I will get out of your guys' hair. Thank you so much again. I hope you guys have a great day, and I will see you in the next one.